Ladies and gentlemen, welcome to the 27th episode of the Futurum Equities Podcast. You got myself, Shay, Boloor. We got Daniel Newman. The market just opened, and I'm seeing it ripping. Space is ripping. ASTS is up 11%. Rock Labs up 5%. What a opening. But anyway, how are you doing, Daniel?
It's good, man. I was signed into our live on YouTube, and it just started playing. I still hate that feature in the browser. Like, it should never just start playing anything without a click through, but doing well, man. I mean, off to a fast start. CES behind Davos. I'm leaving tomorrow. World Economic Forum in Switzerland. 7 days of chaotic travel, cold weather, but what an amazing event in terms of just having the opportunity to meet with so many interesting people. So I'm doing good, man. I'm ready to rock and roll.
Tell us about your, you had a media circuit a bit this week ahead of, I can't believe you went to New York, back to Texas. Now you're going back over the Atlantic. I assumed you're going to stay in the NYC before you go to Davos, but tell us about how your week was. You were very on camera.
Oh yeah, it was a busy week for sure. Actually in New York, working on some very interesting M&A stuff for Futurum. So stuff that could be very interesting for our audience, in a world where, unique proprietary data and insights that help investors, we're expanding the platform. We have an AI technology platform, and Shay, you'll be rolling that out more soon for everybody out there. But, who doesn't have an AI platform, man? All you need is a little vibe coding, a little Claude, but in serious, we've built something pretty special. But, of course, when in Rome, right? When in Rome, New York City, I did, 2 Yahoo Finance. I went there. I did two podcasts, so long form. One already dropped called Markets in Translation. Then I did another one called Trader Talks. So that'll be out at some point in the future. Then I did the Big Money Show. So I was on for an hour on Fox Business on, was it Tuesday? And then I did The Street. I went down and did The Street. I did the Schwab Network. Wednesday went over to Fox Business and did Varney and Company. And then last night I did a 14-minute long deep dive on US, China, TSMC, and NVIDIA on CNBC Squawk Asia. And I'm starting to post those clips up today. So yeah, it was a crazy week, but none of those media moments to me are as fun as getting on here with you and talking to the guy that bought ASTS at $3. By the way, I mentioned probably first time ever on a CNBC interview, I talked about ASTS and Rocket Lab because I was talking about SpaceX's IPO, and I just couldn't help myself but call out the amazing runs and the amazing interest that people have in space, and my amazing stupidity that I did not listen to you and buy into the space trade. I am completely out of this play. And now I'm sitting on the sidelines wondering, did I miss it? Well, you've got a 40 bagger going with ASTS. So good on you, man. Good on you.
Well, I appreciate that. I will say, you've had some massive winners. So don't hold back on those.
Anything that's done as well as your ASTS trade. Just being honest. Like, I have 3 baggers, 4 baggers, some 5 baggers, in my history for sure. But, 20 baggers are really, there's only 2 ways that happens. One is you just get in at the absolute right time on a trend that goes parabolic. That's when it works over a short period of time. But more times than not, it's compounding in time and market, right? It's the people that bought NVIDIA 20 years ago and, believed in the company, just never sold it. People that bought Apple 25, 30 years of holding Apple, and the number of compounds and doubles and triples that you have over a period of time, and splits, Tesla, those kinds of names. But like, the problem nowadays is like, people are mad. I had to talk for 15 minutes, Shay, last night about people being mad that NVIDIA is trading where it's trading at. And it's like, it's up like 1,000% in 3 years. It's like, it's possible that these names need digestion, that, there's rotation, that it's not it does not signify that the company's done. It's worth over $4 trillion, but every trillion is legit. Like, you want another trillion of market cap. I mean, that's some serious growth.
Well, I think first off, I before I get into NVIDIA, because I think that's a natural pivot towards TSMC's earnings. I do want to talk about a little bit a little about space and what's happening because it's bonkers. You're not the only one that is kind of like what's happening the past couple of weeks because the space trade has been the hot pocket for 2026 because I think ASTS is up 50%. I think Rocket Lab now is up 40%. I think there's a couple other names too, like Planet Labs is still doing really well. So what's happening in that whole arena is SpaceX, like you mentioned. I think that's creating a much bigger spotlight in this ecosystem. A lot of people echoed your similar concerns of like they knew about space. However, they always treated more of a speculative story. They treated it as it's such a cheesy way of saying it, but a science project, because for a while, like ever since ARK Invest, like kind of communicated that the space economy is going to be a $1.8 trillion economy by end of this decade. They did this like 5 years ago. The bubble burst in 2022. So when that occurred, a lot of the speculative themes that was communicated before the bubble bursted was treated as a sideline project. So I'm talking EVs, which actually ended up being a not so hot theme going forward. I'm talking obviously space. The quantum is catching a bit as well, but all these themes, speculative themes, kind of got bursted. And space was always treated as the speculative infrastructure story. And then last year, that re-rating occurred across the board. And it wasn't just on Rock Lab and ASTS. Like it was Planet Labs got re-rated as well. Black Sky's getting re-rated. Like it was a whole bucket re-rates because it didn't matter what company you were. Like you caught a bid last year because I think the market's treating against the space economy as a near-term reality in a way because of the sovereign spend that's going to be assigned toward that industry. I do think the commercial angle in space is still a ways away. However, the national security component to space infrastructure is huge. When I'm saying space infrastructure, I'm talking launches, I'm talking LEO, I'm talking orbital infrastructure. Like once you get to space, like how do you maintain all the things that you need to while you're in space? Like that's a whole industry by itself. So SpaceX is still the king, the monopoly of this massive multi-trillion dollar ecosystem. However, just like in AI, when we talk about NVIDIA, like you can't just have one source for the largest build out in mankind's history, which space is that second massive industrial build out that we're experiencing right now, along with AI. You need multiple vendors. That's just how it goes. So there is only a handful of names out there that can get space exposure that are actual real companies that will benefit from a high tide result boat situation. So when SpaceX goes public, it forces a re-rate on all the components of that ecosystem, launches or orbital infrastructure, LEO, like the largest commercial antennas for space connectivity. Like all these things are going to get re-rated because the theme is getting bigger and bigger and getting more and more mature. And that's what you're seeing right now. It's like eventually there's going to be a moment where so much demand got vacuumed into the current valuation. But I don't know, Rock Lab just landed the biggest deal in company history a couple weeks ago, and that doubled the backlog overnight from $1.2 billion to $2 billion. Bloomberg 6 for AST, that was a huge inflection point on can they actually launch these large commercial antennas into the sky, and would it actually physically work? It did. So that was a concept inflection point. And now that Bloomberg 7 is going to get launched, and then Bloomberg 8 is going to get launched after that. So like a lot of these moments are catalytic inflection points. And if you're a tier 1, tier 2 company in this massive ecosystem with a handful of companies that are actually going to benefit, you're going to get a re-rating. And that's what we're seeing right now. I mean, ASTS on 114, Rock Lab is going to might break $100 today, which is amazing to see as well. And they're the second source of the space economy. Like I was on Charles' show last week, and I was just referencing how I've been calling them the FedEx of space for years, because they're fully becoming space prime. Like they were always considered a launching company. They were just yeah, that's how they started. They morphed into something else. NVIDIA started as a gaming chip company. They morphed into the GPU engine for the new AI economy. Like things, that's how re-ratings are so aggressive, because they're type A. The market sees them as type A. However, you have a thesis that turns them into type B, and you front run it. And then as the business execution starts scaling and executing every couple quarters, the market starts realizing it, lagging, but they start realizing it, and then the FOMO kicks in. So you know this especially well.
We talked about this at length last week. Do you think the lack of monetization for revenue or profit and the need to probably dilute to continue to raise capital, even if they have all this backlog, is there a risk that these things are overheated?
So it's tricky because right now ASTS, their way they're monetizing is essentially just stacked on top of all the other OEMs. So they have a different business model where, like, right now I'm looking at their financials. They're supposed to end this year at $60 million in revenue. Oh, but in 3 years, by the end of 2027, it's supposed to be $1 billion. And by then, there's supposedly, the analysts are estimating they're going to have 60% EBITDA margins. So that is, all right, that what I said, $1 billion, so 60%, that's $600 million in EBITDA by end of 2027. Yes, right now it's trading at 40 times that. I think they're at 40 billion actually, so it's 80 times that. It's expensive, but they're going to be growing their top line at triple digits with positive EBITDA starting at 2027. So by then, it's just like, wow, how big can that economy go? Rocket Lab, for instance, to answer your question on that, it's all about Neutron. Like Neutron is how they prove to the market that they can monetize at scale. And that is their medium-sized launch that they're supposed to be launching this year. I know it's getting pushed back a bit. It's supposed to already happen sometime first half of this year, but I don't care when it happens. The only thing that matters is that it does happen and it succeeds. So when that occurs, like, that is 10 times the revenue that they make. They make 50 million per launch compared to what they have right now in the Electron, which is 5 million. Completely different business profile now all of a sudden. And now they can compete with SpaceX if Neutron succeeds. So, like, I think that if the Neutron succeeds, I personally have them producing like around $500 million a year in free cash flow starting in 2028. So the reason I say, to answer your question, long-winded, is I don't think they need to dilute. I do think they both have done that already last year at this elevated valuation. I think that they have enough cash runway until they both hit that inflection profitability period. And when that does occur, like, I think it's just off to the races a bit. But right now, I mean, ASTS is 40 billion, and I'm trying to see what Rocket Lab is. It's 48 billion. So, like, their mid cap, like, it's a different risk profile, guys. Now, I mean, I think they're both going to be higher in the long run, but I got into Rocket Lab.
You buying here? You adding?
I added to Rocket Lab for the first time in years at $38.
And now it's close to 100.
Now it's close to 100. So, like, in my opinion, but if you look at the technically speaking, their charts, it's expensive. It's overheated. Like, they're both RSI on both of them are in the 80s. Actually in the 70s, not 80s. So my favorite rule of thumb is every stock, no matter how hot you run, you will pull back to the 21-week EMA level. Always. Once a year. Like, you're going to.
So is that where you would maybe re-enter?
Exactly. So I think that there's a consolidation period that has to happen with both these names. I don't think these are quarterly earnings stories, and that might be a sober reminder this earnings cycle for both these names. So there might be some kind of profit-taking pullback. I also don't think analysts are going to upgrade these names at all anymore. I think at best they're going to upgrade their price targets, but you're going to probably see some downgrades to buys to holds just because a lot of the vacuum demand's happening right now. But I think 21-week EMA level is where I would really add. So, like, Rocket Lab, the 21-week EMA level it's lagging a bit right here, but it's got to be in the 70s if I had to bet. Yeah, okay. So 21-week EMA level for Rocket Lab, $61. ASTS 21-week EMA level $72. They are both 40 to 50% above that level. So it needs to cool off a bit to answer your question. But I think when it does, though, Daniel, like this is totally up your lane. That's why I was like pushing it so hard for you. I was like, you love the speculative nature of infrastructure in the fourth industrial revolution. Like this is totally that. Would you be opening your mentality now on potentially adding if there's a dip?
Problem is, and I'll be candid, I don't understand space like I understand data centers on Earth. Like I understand semiconductor infrastructure, IT infrastructure, like I understand software. So I need to spend time researching it. I learned nuclear fusion in a month. I learned semiconductors over half a decade. But I can definitely sense space. If you kind of look at the new era of trading around kind of sentiment, trading around momentum, trading and investing around, listening to people who we think are the most intelligent, other than you, of course. You listen to Musk. You listen to, Andreessen, Mark Andreessen from A16. You listen to these people and you're like, what are you investing in? And then you kind of have to think like these people have the most sophisticated quants and they have the most capable scientists and engineers at their disposal to ask what's possible. So I certainly think it's time that I start to spend more energy to learn what is going on in this trade. But I think based on your point, making, maybe dabbling or playing into the market a little bit. Yeah, I think so. But like I said, I would wait for that pullback at this point. Like this feels very much like you're chasing at this point. And I'm a patient investor, so I don't chase.
Well, also like if guys, there's alternate ways to get this exposure. Google owns ASTS and SpaceX. So if you're a Google shareholder, like you do have exposure in the space economy. And I think that it's similar to like if you're bullish on quantum, but you think the pure quantum names are just highly speculative, like, okay, own IBM and own Google. Like there's these hyperscalers provide you exposure in these early secular growth themes that they'll benefit from. Maybe the alpha won't be there, but also the risk won't be as high either. So I think space is a name that was 25% of my growth portfolio entering this year. It was one of the call outs I had in our 2026 prediction shows. It's going to be the year of space. If you thought last year was just wait again, this year is going to be even more explosive. And you're seeing that. I also think it's a great time to talk TSMC because you brought up NVIDIA. What was again, I think if you're an AI bear and you're waiting for the bubble to burst, I would not listen to the TSMC conference call because the most conservative player in this whole economy, the AI factory, they're the ones who dictate the speed of all these AI accelerators innovating. They just told you, the most conservative ones, 2028, maybe 2029 will be the time when supply and demand finally meet each other. It's 2026, guys, just getting started, beginning. So they're saying 2 to 3 years away is maybe when they can see this bubble might have to turn into a glut that needs to digest itself. So far away from that. But I'll give you my insight after. I would love to hear your color. But yeah, TSMC was a great sign of confidence for the AI bulls for sure.
Yeah, they're very careful. I listened to their CFO comments. They don't say customer names. They don't talk about any specific products at all. You can't get much out of them. There was, if you are, as I said, this was a shot across the bow for the bubble bears because TSMC is the leading indicator. There's only one more layer that if you wanted to see where things could break down, and that's the energy layer, where there just won't be enough energy to commission the technology at this pace. But that doesn't mean people won't even buy it and build. It just means they may not be able to energize immediately. But I think, you look across whether it was the top line, the bottom line, the guide was extremely bullish. And then you got the US Taiwan deal yesterday, which basically means, accelerating the build here in the US, bringing N3 to the United States quicker. N2, we know that N2 really was not, that's their 2 nanometer node, was not significant to revenue, but that it ramped up significantly faster than N3, which means they tape outs are sooner. That means they're building and producing more on the 2 nanometer node. And basically my read on it is we're still in this, everything it can build will be sold. And it controls the entire pace of the build out right now is all runs through Taiwan, all runs through TSMC. This is also the reason for all you Intel bulls out there that I'm so bullish Intel is they're going to get their share, whether it's going to be, some share of Apple's chips for consumer, whether it's going to be some subset of AMD or Qualcomm or other inference chip products that are coming to market. I think you probably heard OpenAI went and spent $10 billion with Cerebras, and I know it's a little bit of a tangent from the TSMC conversation, but again, we're still in the situation where compute, this week, whether it was Meta coming out with its whole Meta cloud, which I'm not fully clear on whether Meta is going to be offering its cloud to third parties or this is Meta's infrastructure bill, but I heard about their head of infrastructure building out a team right now of basically like supply chain experts, quants, PhDs to basically figure out how to meet infrastructure demand. And by the way, some of the signal that's coming out of these companies now is that the LLM is increasingly being commoditized. Not a great thing for OpenAI, but that they all are starting to understand that having unlimited compute is going to be what they're able to compete on. So this means the build out continues. It's going to continue out actually longer because in order to build whatever products, whether they're enterprise products or consumer products at scale, they're all going to be battling out for the most compute. So we're getting all the signal. It's showing up in the numbers. And for the short term folks out there, what I see here is that this basically means all the chip companies that build with TSMC, which are all the ones that you guys care about, the AMDs, the NVIDIAs, the Broadcoms, Qualcomms, Google, with TPUs, like they're all, which of course is Broadcom, but they're going to have good quarters because if TSMC's numbers were this big, it means that the demand was huge for all those companies. So this is one, like I said, that at least pushes any sort of real bubble popping at least a few quarters down the road, at least. And I think it's much more than that.
Yeah, I think it's further along than that as well. I think for me, it's hard to call a bubble as well when you saw the guidance that they created. I think that was the gross margins alone was mind-boggling on how much they guided to the upside. Like that uplift was what? You went from 60 to 64%. Like that's not that is not an easy task for a infrastructure player like TSMC. And also the way they work is they're very conscious on how they guide and how they invest because it's not a couple quarters, it's multi-years. Like they have multi-year demand that's causing them to now guide up margin expansion, pricing power. The monopoly on the pricing power is huge. I think my concern entering this print was always going to be the global buildouts margins would maybe erode the pricing power that they have. And I was like, I just don't know if he's willing to really flex that pricing power as much as he should to make sure that headwind isn't really a headwind. Well, they did. So I think that you also heard CC say on the conference call that he was nervous that this being too aggressive at this stage or misinvesting at the scale that they're at right now would be a massive disaster because if they do get greedy and this AI factory just becomes, the capacity becomes so much too quickly, I think that is worrisome on the demand vacuum where the most important industrial operator in the world is telling you that that's not the case. They're going to be very responsible. They're the adults of the AI economy where they're going to make sure that that AI is going to be an improving revenue engine at all layers. I think one of the comments was also he didn't just talk to the customers. He talked to the customers of his customers to make sure that the demand is very real. And that's that shows the governance that's being assigned to this AI economy with this biggest and most important industrial builder and operator is telling you like he's doing his due diligence, multi-layered, to make sure that this is not going to pop and it's very real. So I think we got everything we needed to know from there. I think that's type A. Type B, point B I want to make to you is SRAM is a real thing now. Grok, NVIDIA. Why don't you think that AMD... is it natural to assume, like for me, I'm assuming AMD is going to now acquire Cerebras. I'm blanking on the name.
Cerebras.
Why would they not acquire them? Because AMD has a massive Middle East component to their business. Like a lot of the demands from the Middle East. Cerebras was primarily Middle East kind of demand. Now it's like broadening out a bit. But like, don't you think the natural acquisition is going to be them for AMD to match what NVIDIA is doing with SRAM?
Oh, it certainly could be. I think they have a lot on their plate right now. They've made a lot of big bets on acquisitions. Their decision to whether they want to acknowledge, like I said, Jensen, it was a very subtle way of acknowledging architectural shifts or potential architectural shifts to inference. We haven't heard Lisa come out and really acknowledge that yet. Company has what it believes is the most powerful AI rack scale system, 2.5 ton Helios 5 that based on, again, the problem is, and we need to always put these things through the lab, is they'll do them at different floating points. They'll do them, they put out different metrics at different workloads running in different, AI, applications that effectively make it very hard to compare, say, a Helios 500 versus Vera Rubin. Having said that, they think they've got a great mousetrap. So does AMD need to get into custom or need to think about different architectures? Possibly, but it doesn't have the same war chest. Just be very clear about this as what Jensen has. Jensen can spend $20 billion to hire some talent and not think twice about it because he's creating, $100 billion of cash flow a year right now. That's not the case with AMD. So I do think it's possible. I just think AMD operates very differently when it comes to doing deals. Xilinx was a big risk for the company. That was probably the biggest one. And it generally has to use its stock as currency. So someone would have to be willing to take the stock in that deal, which I don't think is a bad thing. It's just a different thing.
Question for you on Xilinx, because obviously CES, you went there in person. Like the biggest takeaway for me was AI is coming for the real world. Edge AI is going to be a very real thing. AMD's play on Xilinx was for Edge AI. Like that's the reason they made that. That my takeaway. I don't know, maybe if you disagree with that, but I think Xilinx is super expensive and it's very specific use cases where I don't think it works really well when you need very fast, low latency decisions with tight power limits, but like it's not really scalable in the way that I think Edge AI needs to be. So what's your takeaway on like, do you think there's an Edge AI angle for AMD via Xilinx?
Sure. They leaned into that and they talked about, robotics and stuff and what they've done with, Versal, because they're adaptive, right? FPGAs are programmable, field programmable gate arrays, right? It's not a hardened ASIC that has very specific, so it does give them the ability for automotive, which often uses FPGAs, for robotics, which sensibly could be using them as they need to be adaptable and change very, very quickly. So it certainly is a possibility. Right now, I like AMD there. I like more ARM and Qualcomm. I like companies that are very specialized in low power, that have focused on, basically taking a low power SoC. I think that automotive and automotive strength is going to be a big determinant of success with humanoid robotics, because they're going to take the platform. If you think about a robot, it's mobile, it's vision, it's adaptability, it's everything that you do with a vehicle is kind of what a humanoid robot is. And then on top of that, it needs to be super power efficient, because the difference is, the cars can hold these giant expensive batteries. Robots need to be lighter weight, need to be, they're going to need to be more accessible. They're going to need to be lower cost. unless you're Tesla, and then you can sell them for more than a car. So again, I think, they're going to be in the race. I just think that right now, my sort of bets, and by the way, like I said last at CES, you saw with Qualcomm getting like Figure AI and some other, they actually took some of NVIDIA's customers and announced them as design partners, which was super interesting. But I think they're all in it, and it's too soon to determine a winner. And I think one of the things that's super important is with the size of these TAMs, this is exactly like the AMD play in almost every market has historically always been like, look, we can be multi-billions by just getting a few percent of market share. Mm-hmm. I mean, that's what they're doing with Helios and with, it's with the Instinct GPUs. Like, they don't have a huge market. They're going to get 40 to 50 billion in revenue and still only be 5%.
Well, that's what I'm saying. Like, they're tripling their revenue in the next 4 years just by getting a 5 to 10% market share. That just shows like exactly what you're saying. Like, look, being a second source of this economy in the accelerator market is just fun. It's going to be great. I think the issue, though, that I'm having, like during this pullback we experience right now, in that specific pocket of AI, what I mean by that is like anything exposed to OpenAI got punished the past couple months, is the NVIDIA valuation. Like, I'm just like I think a lot of people are also having that difficulty where NVIDIA is still cheap, undervalued, and it's continuing to be more undervalued than AMD after the recent run-up. So like, why bother for the second source when the first source is actually a better discount right now?
Well, it's there's always the contrarians. There's always the people that buy the alternative. There's always the people, there's the people that invested in Lyft, right? When Uber was always out there, It's always obvious Uber would win. I mean, obviously AMD has a great business. They've been successful. Lisa's a great CEO. People invest in CEOs. But I mean, look, right now, I've said that a few times. I said it on 2 or 3 different TV shows this week. It's like, I think NVIDIA's in this digestion period. I think it's had an incredible run. I think there are people that were in it for 20 years and maybe they want to take some profits down and they've been selling. I think institutions are maybe looking for where they can rotate and find their next 1000x, not their next, because when you get to, it's like, it's going to look a lot more like a Microsoft or a Google or a Amazon. And by the way, those have had some great moves. But what if you invested a year ago in Google or invested a year ago in ASTS? Where did you make more money?
Exactly.
And my point is like, clearly Google's a better company.
Yeah.
It's not like Google's like, oh my God. I mean, and I'm not knocking ASTS, but I'm saying like people are rotating into like what other sector, where are other opportunities? Where's other places that I can maybe get the larger returns? And so I always think there are people that want to bet on the big, long, stable compounders, but there's people that are, like I said, chasing right now, and they're chasing where they have more upside. I mean, remember how excited everyone was about GPU REITs? And like, no one gives it. I mean, it's completely dead right now. I mean, the talk around like irons and ciphers 3 months ago, it was like people are not patient, Shy. Like, people look at these things and they want overnight success. They want overnight compounding and multiples. And by the way, they're just moving money around chasing that. People that have been in Palantir a while, I shared something about that. Like, Palantir's gone nothing but sideways for like almost 2 quarters now. Is it over for them? I don't think so. But like, if you're an investor and you're chasing that short-term gain, I mean, look, it's, what did Alex call all his shorts? A bunch of crackheads or cokeheads or whatever he called them on TV. But like, traders that aren't that different. They're a bunch of, they're chasing the high. They're trying to find the next big wave. And I'm sure there's tons of money that's going to pile into Rocket Labs and ASTS is right now. And there's going to be people miserable. This happened with quantum last year. Everyone chased into it at the very, very highs, and then everybody loses their mind with you. Oh, you were promoting. It's like, you weren't. You were saying it was a great buy at $8 and $10 and even maybe $20. But people want that, like, oh, I bought in, now go up and double again and double again and double again. And that's just not how it works.
Well, I think it's interesting though, because,
but it is cheap, so it's great here.
And I think, first off, any company you invest in is just a ticker with a narrative. If you look at the end of the day, that's my phrase I always use. I think the narrative part is driving a lot of these markets now, especially stocks, which is, I think it's because there's more influence. There's more shows like this that are just a communicate on FinTwit. Like, I think X. Like, I'm sorry, I read buy-side analyst reports, but like I get adjacent quality on X sometimes on some of the alpha I received on specific names. Like ASTS, like all my initial content for like analyzing that came from X. It really wasn't covered on Wall Street.
Well, ASTS is up 18% this morning.
No, I'm like I'm looking at let me see what my how much space exposure I have now, because now I was looking at that earlier because I'm like, geez, am I at portfolio management risk? So right now, Rocket Lab is 18% of my portfolio. That's nuts. It's just growing. ASTS is 9%, 27% now. Okay, so
there's time to trim a little, huh?
I that's the thing. I trimmed a year ago on my Rocket Lab. I took all my risk out. So it's all.
Well, Micron's up $23 right now. Today.
I'm telling you, memory is going to be. People are anticipating the bubble bursting in memory. Like it's going to be a multi-year move, in my opinion. I think you're seeing from CES, especially these AI models need to think for longer. Like they're going to become more personalized for the end users. So it doesn't matter which LLM you use, you're going to need more memory because they have to remember the conversations you've had with it, so they can enhance the experience. Like that's the model growth you're seeing right now between all the GPTs and Geminis. Like they're not like, whoa, what happened? It's just incremental pieces that make it more personalized. And
by the way, you're going to need the storage to be fast to connect to the memory, because the memory, of course, what happens when you have massive amounts of enterprise data that you're trying to tap into?
Don't say too much more, because there's one name we're rebalancing, the Futurum AI-15, that has that storage name. We're including a storage name because that is the next theme, in my opinion, in our opinion, after memory. That's going to happen this year, the re-rating. But I'm excited about that.
You want to talk about maybe the ugliest trade? Do you see that post I have of guys hitting themselves in the nuts? And that's being a SaaS trader in this day and age. It was a very funny meme of a bunch of people basically just kicking each other in the balls over and over again. And it said, this is basically SaaS trading in 2026.
I mean, no, we could talk about that because I think that's an important topic. Do you want me to start and you provide?
Yeah, I'd love to get your reaction.
Yeah. First off, as you guys are fully aware, I was very much a software bull 2 or 3 years ago. I thought that the application layer of AI was going to be where the hidden gems are going to get created. The biggest money is going to be made. Palantir is the first one. There's going to be many more. Starting last summer, coincidentally, when I started at Futurum, I was just like, I think the AI tsunami is going to be just much bigger than I anticipated. I don't want any software exposure anymore. And I think what's happening in software right now is much bigger than just a sector rotation that's happening into hardware. I think it's truly market is repricing an entire business model in real time right now, because the SaaS magic for the past decade was always seat-driven expansion post-cloud era, where they were able to produce these predictable ARR results that was like such a safe haven for them with 80% gross margins. They can predict what the revenue is going to be down the line. But now you're obviously seeing that AI agents are going to replace a lot of these seats. And I think that a lot of my interpretation from what my research, I'm like, is this another mainframe era where mainframe got re-rated back in the day? I'm sure you were living in that time era and working in that space where mainframes didn't disappear. Like, I don't think software is going to disappear. I think you agree with that sentiment as well, because they're not going to stop working. I just think that they're still going to be mission critical, but they're not going to be the same growth story anymore, because they're going to become this basic inputs. Just how mainstream became just the basic input that made things just very cheap. Like the PC era didn't kill mainframes, just made the mainframes spend harder to justify. So I think that right now, software, it hasn't been reflected at all yet in the fundamentals, but as the 2026 budgets get communicated to the public, I think there's an anticipation that the same thing that happened when SaaS 8 client servers is going, it wasn't that on-prem stock functioning, it was just that the delivery model flipped the ROI equation where software just made a lot more sense. Like, I think seat-based pricing now is becoming a proxy for labor. So if your revenue model is now tied to how many humans do we have doing the work, then I think you are implicitly you're betting on a digital output scales by adding people, and agentic AI breaks that link. So I think that you're going to see a deceleration in revenue or a deceleration in margins to acquire enough compute to become that agentic AI winner. So I think that right now it's super noisy. I made a post yesterday about it where you saw the repricing across the board. If you're a DevOps tool, a CRM tool, they were all standard. If you have Rule 50 score, you're trading at 35 to 50 times free cash flow. Those same names have the same Rule 40 score. They're all trading in the high teens. That's a bucket. That's a whole re-rate that's happening right now because there's a real worry that software isn't going to have a premium price in this new AI economy. And I kind of agree with that because in order to succeed in software, you have to own the data loop. You have to own the distribution. You have to own the control points. That is historically not what software's been. It's just been layered on top of someone else's data. But I think you're going to see, like you mentioned it right before, like when you were talking to Bill's ServiceNow team, like the gloves are off in SaaS world. Like you can't be a SaaS company anymore. You have to graduate from that. And you're going to see a lot of acquisitions to change that narrative. The issue though, it's going to take time. It's not a flip of a switch narrative change. I think the market's going to need a couple quarters to prove that you're not going to be a sacrifice in the AI tsunami, but you're going to have the lifeboats and ride it out. And that's why nobody really wants to wait that out in opportunity cost. I don't know. What's your take on software?
Yeah, I mean, look, I think I shared something you shared yesterday. I think we're going to see massive consolidation. Companies that were full on publicly traded SaaS companies might get acquired in as features into bigger platforms. I think some of those specialty, very narrow SaaS companies might just get knocked out of business. I don't think it happens as fast. You know, I'm playing with the tech and the code, and you can build things really, really quickly, but there are some concerns and some real challenges that people need to consider related to compliance, governance, sovereignty, where data resides, how it's managed, privacy. When you look at things like HR data, or you look at things like ERP data, where it's not necessarily just going to completely go away. But what you can definitely do with these tools is build that sort of semantic layer, that experience layer, where you can make it much more friendly than these tools are. So like in many cases, even in our own platform, like I'm asking my team to take our existing SaaS and sort of do what Satya Nadella called, like kind of deprecate them to CRUD databases where their data is still there because it's got all the right architecture to be in compliance and to make sure that data safe. But then I'm asking it to be exposed through basically a chat interface. So give me the insight through a chat interface. And by the way, give me insights that sit across multiple SaaS tools in a single view, in a single interface. Like I built a CEO dashboard for the company over a weekend using Cloud Code. And then of course I had to have our developers go in and actually connect all the APIs, do all the sanity checks, the data checks, the integrity checks, security. Security is going to be a big thing. Like when you're building all these kind of self-built apps to make sure this stuff, because a lot of those, the SaaS tools have security layered in to them. Like now you're going to build it yourself, have your own data sitting in your own, storage buckets, and then have to make sure that everything's been properly set up and secure. But look, the idea that, a year ago, people, screamed at me when I went on LinkedIn. I posted that like developers are done, by the way, like, and now you got Karpathy, you've got Boris from, Claude basically coming out and saying like coding is done. Like it is now about engineering and design. Like if you can basically understand philosophically what you want to accomplish and understand how to talk to an LLM, and if you even know a little bit about terminal, like just the basics of coding, you can build apps and you can build really powerful apps really quickly. So the re-rating's real. So I'll leave it at this though. I do think some companies have so much customer, so much scale, so much size, and people have so much familiarity that they're either going to build into this era, meaning collaborate with these new tools. And that's why I think like the Salesforces, ServiceNows, Adobes, maybe Workdays, they'll do okay because like it's just going to be too hard to just completely lift and shift off these platforms. But as it gets easier, if that's your only moat, I do worry And I do think the re-rating is probably permanent. Meaning, I don't think anyone will value these categories like they once were valued anymore because it's seen as too obviously ripe for disruption in the future. Even if they're able to hang on like Adobe has and shown great growth quarter to quarter, people just don't believe it's going to be able to sustain that over the long term.
I mean, I want to ask you this. First off, I just looked it up right now. Anthropic's worth almost two Salesforces right now at the valuation. That's crazy.
Anthropic's a machine, dude.
That's what I'm saying. Like Anthropic, I think there's a real angle. Like you and I both agree LLMs are a basic input in the AI economy. Like right now, they're not being priced in that way. There's like a very much of a shiny era, so they're overvalued a bit, but they have the potential to leverage this moment to become something much greater. So for me, I'm like, all right, obviously I'm not saying Anthropic should acquire Salesforce and like all of a sudden dilute 40-50%, but like why they have a massive enterprise presence. Like that's Anthropic's whole thing is engineers, developers in the enterprise space. Like OpenAI owns the consumer chatbot. I think they own that arena. I don't think that's not going to get disrupted anytime soon. However, Anthropic owns the enterprise space. Like why not acquire GitLab for $15 billion? Get all those tools, become a duopoly with what Microsoft's doing. Why not acquire Monday.com to be somehow get that infrastructure in place for that CRM and just put it into cloud? Like Claude, do you not think that's smart? Like leverage that $350 billion valuation, acquire a couple great, highly profitable tools that are in the mid-teens billion and just like put it into your ecosystem. Then you become this massive enterprise disruptor all of a sudden that maybe you solve AGI, maybe you don't, but now you actually have an enterprise presence.
Yeah, I mean, look, I think, whether, like I said, it's Meta hiring these specialty people to focus on tools, supply chains, and Manus and the agents, like what they're doing. I think whether it's going to be OpenAI and partnering on verticals, like they're all going after it. Like, let's be very clear. They are going after it. The question is it kind of a better together? And can they go after it more effectively if they kind of take advantage of the architecture and structure that these SaaS companies, and not to mention just the creative value of all the customers they already have, versus trying to lift and shift. Big enterprises just don't move that quickly. And I mean, I think that's the thing people are kind of overestimating is how fast a large company might move off a CRM or an ERP system. I mean, you're talking decades of code building and optimization and inside of an Oracle system or inside of a SAP. You came from that world, Yeah. I mean, you still had green and black terminal mainframe computers that were still used for things inside of like in 2020. I mean, it just takes a long time to get all the data. But the point is like clearly it can be done a lot faster. I mean, talk about Claude Cowork. I mean, literally, like I talked to people this week. I'm like, first of all, they built that thing in 10 days using 100% Claude code, and they basically, and I don't want to be, I like Microsoft, but like they kind of did what Copilot was supposed to do that week. And the people that are using it say it's better. And so, the bottom line is that is where this is a perfect example where a sort of legacy technology company that had all the advantages of the enterprises, the customers, the data could have built something in a trusted environment with all the things I said are the hurdles. But the question is, how many large enterprises are going to call up Microsoft right now and say, I'm done with Copilot. I'm done with Office. I'm done with, and I'm just going to move everything over to Anthropic. And even if they want to, how fast can that be done?
No, the red tape bureaucracy is very real. And then it's enterprise arena. It's like, but I think it's what you're communicating. There's a crack now. Before it was like fully insulated, high barrier of entry. Like nobody can disrupt enterprise suite that Microsoft.
Oh, you see that X is down completely,
which is a great reason why we fully moved to YouTube.
Yeah, we would have been
down. So I think I want to leave more time for. I know we're wrapping up in an hour. I did want to leave more time for questions.
Yeah, let's do it.
I think last time we talked too much. I'm looking right now at the market though. It's interesting because Q's red, but what's really green is ASTS 15%, Rocklab 7%, Iron's up 7%, IonQ up 4%. Like, I think there's a lot of these speculative themes are catching a bit, but
Cypher's up 7%.
Yeah, Cypher's up 7%. So let's go to this question. Let's do it in order. Ooh, someone Giad Mablu, up 2,000% since the April lows. Definitely made a lot of money on Daniel's recommendations. Thank you. Look at that.
Nice.
If I want to put that up, I don't have the option to, but it's fine. Next question. Next bottleneck after packaging, optics, memory, energy, packaging. I think specifically in Arizona, I think that's the next like bottleneck. If you want to talk about, no, it's tricky. Bottleneck. I do think storage, memory is a clear bottleneck right now. I think storage is the one that nobody's talking about yet. I think that domestic packaging is one that is not getting as much spotlight. I'm talking Amcor. I think TSMC is fully going to continue their momentum of building these foundries in the USA. There's only 3 states you can do that in. I know it's Oregon. I know it's Arizona. I think it's Texas is the third one. There's only so many locations you can do that in. And I think that for Arizona, Amcor has a huge presence for packaging. I think that's why you saw a massive bid at the TSMC's earnings. Yesterday was Amcor's up 10%. So I think I have a trade on Amcor. I do want to communicate that I am talking my book. I have some leaps I bought in when it was in the 30s because of that packaging element. But I think memory and storage are the next ones. What are your thoughts on that?
Yeah, I mean, look, capacity expansion, U.S. red tape on buildouts is going to make you've seen how slow TSMC went, how long it's taken Intel to get up. I like Intel still because I think they're going to sell out all the packaging capabilities because it's just so necessary. Again, we know we like TSMC, so I don't think that needs to be discussed here.
Well, can I ask you on Intel, like, why not just spend like 50% more money on all of TSMC's engineers? Like, throw money at like Zuck does and just get them over to Intel.
I don't think I think Lip-Bu has hired some people from TSMC. There have been some people, and he has those connections, but I don't think it's that easy. First of all, they're all in Taiwan. All the real talent's in Taiwan, like their top talent.
Yeah.
So, do you bring them here? I don't know what the capacity to do that is. And I don't know if they would just let them run. I do think this is a slightly different talent. It's a much smaller pool than even AI researchers. It's very specialized. So, but I could see the talent wars heating up for Foundry, certainly. I was the Micron guy for a long time. So, been pounding that one. It's obvious. And so I'm also thinking like I use Pure Storage, which I think was cool. I saw Gavin Baker, another, I think great mind in this space. Also, I think that's his biggest position, actually. I'm talking about,
I didn't know that.
Yeah. I'm talking about it just through the need for all flash, high performance, storage solutions, to basically have all this data with low latency, intelligence in the software of the data. So basically the data to the memory to the compute is as streamlined as possible. So I think Pure is going to catch a bid. I think it's very interesting.
So you're talking about on-device inference essentially, and I think that's the massive tailwind for storage.
Yeah,
as well.
And of course you've seen like SanDisk, Western. I mean, those companies have absolutely exploded. I mean, talk about left for dead. And now, I talked to the street about this. I mean, look, my only concern is some of these have run so much, but I don't think the shortages are done. So it's like, it depends. Like if you've seen it go up 80% year to date, like I wouldn't necessarily know for sure that's going to go up 80% again. If you're looking at it through that lens, but like there is no sign that we have enough storage. So storage companies, both storage disk and like storage and software, like Vast Data, which is not publicly traded, but I think they could become a very interesting IPO or an interesting acquisition target. Weka, another company in this space. Basically, these companies that have built these intelligent semantic software layers that kind of help storage become more efficient for AI and compute. These super interesting companies at this point.
No, I agree. I like that answer. Next question. Whoa, we got a lot. We should probably leave more time next time. All right. So AMD grow faster than NVIDIA going forward. Both are too cheap, but estimates are way too low for AMD. Yeah, I mean, you're making the argument that inference is going to be vastly greater than a lot of the bull thesis. That might be the case, but again, however much of the incremental bump that AMD is going to get in that market, I think NVIDIA will match that. So I think it's a tricky argument to say it will grow fast. It's just
the real question is, does AMD take share? That's the question. Do they take share? Because we already know that when it comes to like strategic supply, I don't think anyone's had the ability to have the influence that Jensen's had, just the ability to commit and write checks and basically overpay TMC's incredible pricing power to make sure it has as much capacity, CoWoS, wafer, whatever it needs to build. And I think for AMD, the answer is, do they get software right? And I know software is more about training and ongoing than it is purely about inference. But I still think, same as I said about enterprises and their pivot away from SaaS and what's sticky, I mean, the moat of CUDA is real. And I still think people underestimate that moat, and it makes for great headlines and great TV.
Totally.
But the nice news is I still think, Shay, it's all we can build, all you can sell. To me, however much capacity Lisa can get committed, she can sell. And so if she can get enough capacity, she will grow. And if she needs more capacity, as relatively more for her each generation than Jensen is able to get, she can possibly take market share from it. Totally. I just don't know if it's going to take market share purely on competitive metrics.
Totally. And I also think that you mentioned the software component. Like, I think people think it's just a flip of a switch moving from CUDA. Like, all the engineers that learned everything from AI learned it on CUDA. To tell them to switch to AMD's offering is not as simple as just like flip of a switch. It's a learning a brand new language. It's like you spent the past 5 years trying to perfect Spanish. Now all of a sudden you're being told, like, all right, go learn Mandarin right now because we might get a better return on our dollar. It's that different. That's the difficulty Lisa has right now on that software sell is every engineer right now has got learned on CUDA, and now you have to have an enticing enough offering to make them stop learning on that. So that's a big issue. And I also think that what was I going to say on AMD? That's enough on AMD. I lost my train of thought. But next one, security stocks. Like, why is cybersecurity stocks pulling back with the SaaS narrative? I think right now, it happens all the time. Names get lumped into similar buckets, and doesn't matter what you do, you're all going to get sold off for the immediates. So right now, AI security, I fully agree with you that AI security is the AI agents going to be a massive tailwind for AI security. Like, that's not going to get disrupted by LLMs or cloud. Like, you're going to need security. Digital products explosion we're going to get in AI economy creates more data. What do you have to do with that data? You have to protect it. But as of right now, doesn't matter what you do. If you have a software industry tag next to your name, you're going to experience the pullback. But if you look, CrowdStrike's pulled back, like, they're not 4-year lows. They're 20% off highs, maybe. Cloudflare, 20% off highs, not 4-year lows. Zscaler, 30% off highs, not on 4-year lows. Like, they're pulling back, but zoom out, they are substantially higher since the ChatGPT moment. When all the other names that we're talking about that's Gen AI vulnerable, I think they're probably below where they were at when that ChatGPT moment happened. And that's like, by below, I mean the multiple, not the stock price. They're multiple. So I think that really important to zoom out a bit. I don't know. What's your take on why cybersecurity is pulling back as well?
I think the question is, does it deserve a re-rating, and does it face potential disruption similar to software? Meaning, can we build security applications the way we're starting to think about building SaaS applications? Like, we're starting to build workflow applications. A lot of these companies are software companies. It's security software. They're not hardware. They're not, they've built software architectures that protect perimeters, that protect software workloads, that protect storage, like all these different things. And what I mean by this is it starting to get entwined in the thought that maybe these categories have risk, and they haven't had risk.
So you're saying a lot of these cybersecurity companies, their clients are software companies. So if the software companies start reducing over time, there is technically like less clients now that will have to use those products.
There's a pull through, but they're actually cyber companies are software companies.
Yeah, I know. It's like a
cyber software. I mean, look, I mean, we're not talking about like, gateways and gatekeepers and physical security like Cisco sold 20 years ago. We're largely talking about software that sits on top of software that's very specifically used to, whether it's, to track, data like a Splunk would do, just tracking it for security, or, network security, which is a cloud and AI application. I mean, I talked to the founders of Palo Alto, like the original. I mean, he was basically saying that it's all software at this point. It's all AI at this point. So the question is there, I guess I'm just saying, like, is there some risk to these companies that may be starting to be felt as it and being dragged? Like you said, the risk isn't as high. It's certainly not as immediate, but are they being dragged along? Is security not necessarily been getting the scrutiny, but does it deserve some? Could we be building new security apps that sit on top of our new applications that we're building?
I also think cybersecurity is a highly fragmented industry. I don't think people realize how many offerings there are, how many companies in the private and public markets. Palo Alto, obviously, you have to be able to sell a platform narrative now in the software land if you're going to actually pitch that you will win in this AI economy. And they've done that with CyberArk, and I think they had another acquisition I'm blanking on after that. I think they're eventually going to acquire SentinelOne. But I think that the biggest tell for me, CrowdStrike has always organically created new modules. They have not had to do the acquisition route. They've just made 2 acquisitions the past 2 months. I think you're seeing gloves off even in Cyberland on we need to continue innovating with new modules to sell the platform on the latest and greatest, because it's such a fluid part of the AI cycle where you can't be comfortable with what you are. You have to make sure you maintain your lead in what you do, because everything's changing at a rapid pace. And I think that's going to continue. And the issue as a shareholder is synergy risks. These could be great long term, but if you continue acquiring at this pace, there's obviously going to be synergy risks. And nobody really knows when that's going to be over. And everyone's worried about holding a post Salesforce. Like, Salesforce was a BI tool consolidator in the cloud era. They were able to sell the platform narrative, but you saw over time how much that dilutes shareholder return because of synergy risk. Like, maybe you made a couple bad acquisitions and all of a sudden you're holding the books on. It's difficult, noisy, and ugly. There is a worry that in this AI era, these software companies are going to have to follow a similar playbook, and it becomes messy, where the whole thing on software was, geez, this is a clean business model, 80% gross margins, predictive revenue through seat expansion. Like, it was as clean as it gets in cloud era. Now it's becoming messy. So I think that is probably why it's driving AI security. And also, like, they're all trading at 50 to 60 times free cash flow multiple. Like, they have triple their multiple as all the other Gen AI software names. So, like, it's just getting re-rated. It was expensive before. Anyway, let's do one more, because I know we're way over. Digital Datadog. I think Datadog's a really good one, because this was a name I was very bullish on 2 or 3 years ago. And then I was like, I'm super bearish on Datadog now, not based on them going away. Again, I think they will still be around. But what is the one thing that AI agents solve? Making sure you don't overspend is very easy for them on their on cloud spending. That is one of the main things that Datadog does, is making sure their customers don't overspend on the cloud, observability. They have a ton of other features. I'm not saying that's as dumbed down as that, but I think that's an example of, like, oh, so OpenAI, all these AI native customers of Datadog from a couple years ago, they use Datadog for observability, but now there's so many tools out there that they can create the in-house solution to what Datadog was offering. And Datadog has the best go-to-market strategy. They're expensive. Like, that's their whole thing. So now all of a sudden, if you're AI native customer or clients, why spend on this service when you can create a good enough service in-house at a one-time cost? that's the issue with Datadog. And I think that's why Datadog's got a consumption model. But I do believe they actually deserve a much bigger re-rating towards the 20 to 25 times free cash flow than what has been traditionally used for them, which is 45 to 50. So I think that's kind of what's been with Datadog. What's your takeaway on that?
Don't have a super strong opinion on that one. I think your answer was better than mine would be.
Oh, I'm learning from the best. So that is, it looks like Twitter's up again, which is great because the world would burn down if Twitter was down for more than 1 hour. This is a great episode.
What would you do all day?
I read, I guess. I finally have time to read. I will say, though, it's always the best time of the week. I wish we could do more of these. I know that a lot of you guys have communicated, like you guys want more of us, the Dan and Shy show. But I love episode 27. I love that the momentum we're getting on YouTube is incredible. So like subscribe, like it. I think that a lot of Daniel and I are very new to the YouTube game. And I think that's we're not influenced. You guys maybe think I'm an influencer first because of my Twitter profile, but like I'm very much like not that. And I have a difficult time like becoming that at times. So YouTube is very much the influencer game. So please communicate what do you guys want better for us. Like the video if you enjoy it, dislike it if you hate it. Subscribe if you want to get notified. I know I need to do a better job communicating when the videos are happening and not just 10 minutes before we record. And I got that.
We'll get on that eventually. We'll get better.
We're learning. This is episode 4 on a YouTube channel now, like exclusively. So I'm happy with the way things are going.
We're getting a great audience. I'm going to challenge one audience member to a bench press competition this year. I think we're going to do
what's the handicap? Like, do you have to do half of what Daniel does?
Oh man, I got someone that can outdo me. I mean,
no way. What's your how much do you bench right now?
I don't max. I'm an old dude now, but I mean, I do working sets at 315. I can do 8.
315, 8. All right, so I did 245s on each, 90 plus 90 plus. That's insane. I do 205 is what I can do. Wow. That's insane. Good for you, man. I don't know how your shoulder handles that. That's crazy. My rotator cuff would just get destroyed.
Well, I mean, it's the roids. I'm just kidding. It's the peptides. It's the peptides. We'll go into that some episode. We'll have to introduce the world to peptides that help you think more clearly and make better trades. I mean, I can't say that's actually true, but I mean, some influencer on YouTube probably says it's true.
Well, I'm still waiting for mine, so I can't wait to have it. But
we will. We'll get you there. We'll get you on the sauce. But hopefully everybody out there, this is the sauce, right? I mean, this is the weekly. Come hang out with us. We appreciate you all. I mean, Shai, it's been great. I mean, we really appreciate all you joining and subscribing. And I just appreciate the chance to sit with such a smart guy all the time, just being in your orbit.
No, not at all. I'm learning. My strategy has gone so much better on how to read data since starting at Futurum. So appreciate you and appreciate everyone else for hopping on as well. So tune in next week. Earnings started this week a bit with TSMC. Next week we got Netflix and Intel is the main ones. Intel will be really interesting to be honest because they've
Tesla cooking next week or the week after.
Week after. So the week after is really when it gets going. Monday's off, everyone, for the market as well.
Except for me,
except for you. So yeah, tune in next week, same time. I think we're gonna do Friday morning, probably around 9:30 Eastern as well. It's a solid time, but thanks for hopping on. See you next week.